If you click this video, to a large extent, you are planning to buy your first home in Canada. Today, I will share with you the mistakes that we did when we bought our first home in Canada and what you can learn from us. And I will burst some of the myths that are floated by some mortgage brokers and realtors to first-time home buyers. So the first thing that you should do is sit back and imagine what you need in your first home. Perhaps 4 bedrooms and 3 garages with a swimming pool in the backyard. Who doesn't want it? But let's do a reality check. Let me address the elephant in the room first. The home that you can afford is very largely based on your income. And when I say income, it's about your household income. You and your partner, if you have one. There's lots of noise around credit history and all that. It really doesn't matter that much. It does matter, but not so much as glorified by some of the mortgage brokers and folks on the social media. Then comes whether your income is coming from a business or you are a T4 employee. If you are a full-time employee, a permanent employee who is not on a probation and working for more than 6 months, that's like an A+ category, or you can call it a gold standard. If both you and your partner have this kind of profile, awesome. But if you have a business or you are an independent contractor, you have a company or you have a partnership, then it gets a little bit tricky. It's not that you can't buy, it's just that a bit of more paperwork is required, because banks should feel confident that you can pay the mortgage, you can afford, and you won't miss the payments. So in case you're planning to switch jobs or careers or go back to school and at the same time buy a home, then reconsider. Connect with a mortgage agent and seek their guidance. Let's say you have a permanent job, full-time, T4 income, then comes what debt you have. Do you have a car loan, student loan, credit card debt, personal loan, etc.? If you don't have any of these, then congratulations, you're doing everything right. So depending on your situation, but as a general rule of thumb, the house that you can afford is 4.5 times your gross income. Let's say you and your partner together make $100,000 a year, then the cost of the home that you can buy and you can get a mortgage for would be about $450,000. So if you make $150,000, then you can go out and buy a house worth $675,000. It can be more, like 5 times, but 5 times of your household income is the maximum that A lenders like TD Bank, BMO, CIBC, etc. can give you. It could be less if you have other debts like car loan, credit card debt, etc. Now you have determined that. Let's talk about things to do before you contact a realtor and your first foot on the ground, like house showings, etc. If you have an existing debt like a car loan or a credit card debt, then consider to pay it off. Why? Because it adds debt on your personal balance sheet. What is your personal balance sheet? It's your money coming in and money going out. Let's take a simple example. Let's say you make $500,000 a month. Then out of that you pay federal tax, provincial tax, employment insurance premium, and your CPP, Canada Pension Plan. Let's say $4,200 hit your bank account. Bank sees how much money is leaving out of this $4,200. So if you have a car payment of say $700 a month, so $3,500 is what is left. The more money you can prove to the bank would stay, the more mortgage payment you can afford. The more mortgage payment you can afford, the higher would be your mortgage affordability. I'm not suggesting you to buy the maximum amount, just saying affordability or the eligibility. if you qualify for a $600,000 home and you go out to buy a $500,000 home, great. But the reverse will not be possible. That you qualify for a $500,000 and you want to buy a home for $600,000. So first thing, reduce existing debt payments as much as possible. For example, if you have 2 cars on loan, you may consider selling one if possible and look out for some income avenues over the weekend to pay off that credit card or car loan. Once you have your existing debts under control, ideally 0, if not, then fairly reduced, then look at your down payment. For a $600,000 home, the minimum that you need is 5%, which is $30,000. It is best to have 20% or $120,000 in this case. The reason being, if you're putting less than 20% of the home value, then you need to compulsorily buy a mortgage default insurance. This is mandatory. This insurance costs approximately 2.8% to 4% of the value of the property. So if the home that you're buying is $600,000, the insurance premium would be somewhere between $16,800 to $24,000. It all depends on how much down payment you put. The more down payment you put, the lesser would be the premium. And on the reverse, the lesser the down payment, the more the premium. As simple as that. You don't need to pay it upfront because this is rolled into your mortgage. So the key thing to remember is that this insurance that you're paying is only for this house. If you sell in 3 to 5 years, you get nothing back. It's gone. So be aware of this cost if you're putting down less than 20% and if you don't plan to live in the house for long. So the next question is, where should be your down payment? Your down payment should be in liquid form. Like, it should not be a GIC maturing in 5 years. It should be in your checking account or your savings account or in a high interest savings account or something like that. The reason being, the moment you submit an offer of purchase to a house and your offer is accepted, you have to deposit a token amount, generally $10,000, within a day or 2. So your down payment should be liquid, not in gold bars or diamonds. It should be available in your bank account the same day. Let me take a moment to explain FHSA, the First Home Savings Account, which was introduced in 2023 for the first time. If you do not have any home in Canada, then you are eligible to open this account and you can put $8,000 a year into this. Let's say your marginal tax rate is 30%, and if you put the full amount of $8,000, then you can expect to get a tax refund of $2,400. So every year you can put $8,000 up to a maximum of $40,000 of total investment. Once the money is in your account, and depends on where you invest it, your money goes tax-free. So if you're not planning to buy a home, then it could be a good idea to invest in mutual funds or stocks or ETFs. But if you're planning to buy soon, then it is better to go for low-risk investments like GICs or bonds. Even if you get 2 to 3% return, it is still a good deal because it adds on to the 30% return you anyways got as a tax refund. Lots of people do not like to invest in stocks, mutual funds or ETFs because they don't want to lose the money and because they're planning to buy a home in the very near future. So $8,000 per person, and if you're a couple, so $16,000, you can put it away in your FHSA accounts. You can withdraw only to purchase your first home in Canada, not to go on a vacation to LA or Florida. Now let's say you bid for a house for $600,000 and your bid is accepted. Congratulations, you have 20% of the $600,000, which is $120,000. Now what will be the next steps? Well, there are some closing costs like a lawyer fee, title insurance, land transfer fee, moving costs, etc. Let me touch each of these very briefly. A lawyer is required for all the paperwork like transfer of title, etc. You can't avoid that. It should cost about $2,000 depending on your province and region. A title insurance is to protect you. Let's say if someone comes up in 2 years and say, hey, this is my home, you were the victim of a fraud. So this insurance takes care of any title related issues. A general rule of thumb is it costs about $100 per $100,000 of home value. So for a home valued at $600,000, it should cost approximately $600. The land transfer fee, they are not applicable for first-time home buyers in Ontario. I'm not sure about other provinces, so check it out before you sign on the dotted line. Then comes the moving costs. Well, it again depends whether you're moving within the city or within the province or between province. From Vancouver to Halifax, it would vary. I won't put a number on that, but it totally depends on your situation. That's not it. Wait, if you have been a tenant, then you might not be paying some costs that now, as a property owner, you need to budget for. Firstly, property insurance. It could vary drastically from $50 a month to $500 a month or more. Property taxes could again vary from like $60 a month to $600 a month. Water, garbage and sewer could cost another $80 to $150 a month. Heat or natural gas, it could vary depending on the season. In winters, we generally pay more. In summers, it's very less. But on an average, it could be about $80 to $120 a month. You need to budget for it. Why I'm saying this is that you should be aware of these costs before you buy. These costs are a rude shock, which many first-time home buyers are kind of aware, but they don't really budget in their monthly expenses beforehand till the bill actually arrives in the mailbox. And we were a part of this cohort. We just thought, it's just mortgage and hydro. That's it. We were wrong. We're completely wrong. If you're buying a condo, then the maintenance fee might cover some of these like heat and water, depends on the condo rules. But anyhow, these facilities are paid for by the condo owners. And all these costs need to be budgeted in your monthly budget. And you should be aware of these before you buy the house. That's it for today. I wish you the very best in your home buying journey. This journey is worth every minute of yours. That you invest in finding the right place, the right realtor, the right mortgage agent, your discussions with your partner, how much offer to put on this house, and everything in between. I hope this episode was useful to you. See you next time. Bye now.